Let's jump right into this massive industry shakeup. Welcome to This Explainer. If you've been watching the business landscape recently, you already know the era of the massive, do-it-all conglomerate is facing a serious test. Right now, we're looking at one of the most historic corporate restructurings in modern entertainment and telecommunications history, Comcast's 2026 spinoff.
We're breaking this down into 5 parts: the Great Comcast Split, why break it up, the new Comcast connectivity focus, NBC Universal's Parks and Peacock, and finally, the financial reality check.
Section 1. The Great Comcast Split. The sheer scale of the separation being proposed here is absolutely massive. Based on the June 2026 press release, Comcast is executing a tax-free spin-off to create 2 independent, publicly traded giants. This isn't just some minor reshuffling of assets. We are talking about a foundational unwinding of a media and telecom empire they've spent decades building. And they're aiming for a clean break by mid-2027, giving them roughly 1 year to finalize the whole transaction. The dividing line here is pretty clear-cut. It's essentially tech versus entertainment. One side becomes the new Comcast, which will be a pure-play technology and connectivity leader. Think broadband, a rapidly growing wireless division, and business services operating on a massive network reaching over 65 million homes. On the flip side, NBC Universal becomes a standalone media and entertainment powerhouse. That puts the Universal theme parks, Peacock, the NBC network, European giant Sky, and those legendary film and TV studios all under one independent roof. So what's the ultimate goal? Chairman Brian L. Roberts puts it pretty bluntly: agility and focus. He noted this transaction is meant to unlock a more entrepreneurial management approach, and they're totally shaking up leadership to make that happen. Michael Angelakis, their widely admired former CFO, is actually returning to take the reins as CEO of the standalone Comcast connectivity business. Meanwhile, current co-CEO Mike Cavanaugh steps up to lead the independent NBC Universal. Both leaders are essentially being tasked with aggressively investing in their newly focused lanes.
Section 2. Why break it up?
Well, maintaining a unified conglomerate just wasn't the best strategy anymore. According to a deep dive by S&P Global Ratings, Comcast has been getting squeezed by intense, compounding pressures across its entire portfolio. On the cable front, telecom rivals are aggressively expanding fiber-to-the-home networks. At the exact same time, low-priced 5G fixed wireless broadband is swooping in to grab market share. Over in Europe, Sky is getting hit with the same severe cord-cutting trends we've seen stateside. And then you have streaming. NBC Universal's Peacock is definitely growing, but it's primarily domestic. It just lacks the true global scale of a Netflix or Disney, and that really limits its international potential. To put those broadband pressures into perspective, S&P now expects 5G fixed wireless access to capture a staggering 15% of the overall broadband market by 2028. This tech has vastly exceeded early expectations. Competitors are coming in hot with highly competitive, low-priced options, and it's putting a very real dent in traditional cable broadband additions. Then you've got the media side of the equation. Universal is churning out massive studio hits. Just look at the incredible success of Wicked. But S&P pointed out a major bottleneck. To fully monetize that incredible content library, you really need a massive global direct-to-consumer platform. By spinning NBC Universal out, it gives the company the total freedom to partner, merge, or aggressively expand internationally without being weighed down by the regulatory and capital constraints of being attached to a U.S. broadband utility.
Section 3. The new Comcast connectivity focus.
To survive the broadband wars, the new Comcast is going on the offensive in mobility. In the first quarter of 2026, they posted a record 435,000 domestic wireless line additions. That brings their total domestic wireless lines to 9.7 million, meaning they've penetrated roughly 16% of their residential broadband customer base. Now, they are still battling residential broadband subscriber losses, but they've actually managed to slow the bleed quite a bit, with Q1 net losses improving to just 65,000. How are they doing it? Through heavily discounted mobile bundles and new multi-year flat-rate pricing strategies. They're essentially using that booming wireless service as a shield to protect their broadband base from fiber and 5G competitors. Also, purely as a strategic financial move, Comcast is holding on to up to a 19.9% stake in NBC Universal for up to 1 year after the spinoff, giving them excellent capital flexibility.
Section 4. NBC Universal's Parks and Peacock. Over on the media side, Peacock has some serious momentum. In Q1 2026, the streamer reached 46 million paid subscribers. But check out this revenue growth. Peacock broke the $2 billion mark for the quarter. That is a massive 71% jump year over year from the $1.2 billion they reported in Q1 of 2025. This surge was heavily fueled by huge live events like the Milan Cortina Olympics and the Super Bowl, proving that their big bet on live sports as a streaming anchor is totally paying off.
And here is a really fascinating dynamic. Nearly 78% of Peacock subscribers are using the ad-supported tier. In the broader streaming landscape, Peacock has one of the highest shares of ad-supported viewers, trailing only Amazon Prime Video. That makes Peacock a massive, sustainable driver for future ad revenue, with projections suggesting they could generate $2.7 billion in ad revenue alone by 2026.
Meanwhile, on the experiential side, the theme parks are basically printing cash. The opening of the massive Epic Universe Park in Orlando in May 2025 was a total game changer. For Q1 2026, theme park revenue hit $2.3 billion, up over 24%. Adjusted EBITDA surged 33% to $551 million. That phenomenal domestic strength, driven by incredible attendance at Epic Universe, is allowing them to easily absorb some softer attendance and economic pressures currently hitting their Asian parks in Osaka and Beijing.
Section 5. The Financial Reality Check. So, the underlying businesses are performing well in their own lanes, but what does the balance sheet actually look like when you pull a conglomerate of this size apart? S&P Global tightened Comcast leverage downgrade threshold down to 2.5 times, citing a slightly weaker view of the overall business due to those fierce industry pressures we talked about. S&P expects the spin-off mechanics to temporarily push leverage up to 2.6 times in 2026. However, they forecast it dropping comfortably back down to 2.4 times by 2027 as the new corporate structures stabilize. Despite the turbulence of tearing a massive company in half, S&P still affirmed Comcast's strong A- credit rating with a stable outlook. Why? It all comes down to cash flow. The combined entity generated a staggering $3.9 billion in free cash flow in just Q1 of 2026 alone. This incredible liquidity gives S&P total confidence that Comcast can simply moderate its share buybacks over the next couple of years to keep leverage safely below that 2.5 threshold. They'd even have positive net sources if EBT dropped by 30%. It's a bold bet on the future of media and technology. Comcast is openly acknowledging that the synergies of yesterday might actually be the anchors of tomorrow. By freeing NBC Universal to chase global scale and freeing the new Comcast to hyper-focus on the broadband wars, they're charting a radically different path forward. It really leaves us to wonder, will this great unbundling ultimately create more value than the massive empire it leaves behind? Thank you for joining me for this explainer, and definitely keep your eyes on how these two new giants navigate the market in 2026 and beyond.